Good afternoon, everybody. I think after a session on real estate, which is very close to each of our own, personal lives, this is going to be a little more theoretical in terms of how mid-market private equity is shaping up and would be shaping up. I have the advantage of having a very distinguished panel to which to moderate. So, Gopal, Sri, Inderbir, Akshay, and Abhi, they are veterans in private equity, and they'll be able to give a perspective of how mid-market private equity has been shaping up and should be shaping up in the future. Before we get into questioning each one of them and then hopefully come to some bit of overall consensus or otherwise, we will see how it goes. Request each one of you or the panel to give a quick introduction of yourselves and your firm so that folks here get a perspective as to where you're coming from. Gopal, we'll start with you.
Thank you, Jayanta. I work with Gaja Capital. Gaja Capital is a mid-market growth capital firm. We've been investing for 13 years, consistently across 3 sectors: education, consumer, and financial services. I've been investing in India professionally since 1990. I started with public markets, started investing in private equity in 95, and since 98, I haven't invested in public markets. My own interests are in education, financial services, and a bit of consumer. I have a background in technology, so I was a lousy engineer when I was in college, but I'm in a way going back to my roots and gives me an interesting angle on many of the new things that's coming up. So with that, I'll hand over to Sri.
Thank you. I'm from True North. True North has been in existence for the past 18 years. We've raised about in excess of about $2.5 billion over these last 18 years. Managed, as again, largely mid-market. I guess everybody says mid-market in India, right, if you're in private equity. But we've been doing a significant amount of our capital has been going into what we call buyout or control transactions. I've been with True North for about 12 years. For a long time, we have not been sector focused, but now I look at consumer and financial services to a large extent.
Good afternoon. I'm Inderbir. I work with the International Finance Corporation's asset management company. The asset management company is a third-party private equity initiative of the IFC, and we currently manage about $10 billion across 13 global funds, or funds globally. Until I'm currently with the Emerging Asia Fund, which invests across sectors across Asia, emerging Asia. And before that, I used to invest in, I used to look at all the private equity in financial sector across Asia, including India. So I've been doing this for now about 13 years. I'm not a veteran as many of the people here. But given our mandate, we do only mid-market and minority. So unlike True North, we don't do buyouts.
Hi, I'm Akshay, and I'm here with East India Capital, which is a multifamily office based in Singapore. Our group manages about $500 million of family and institutional capital. It's a subsidiary of a UK headquartered firm called Milltrust, which has different vehicles, including an agri investment vehicle and an innovation vehicle. Out of Singapore, I lead most of the private equity venture capital allocations and investments into direct opportunities. Unlike most of the panel, I'm quite young and I don't really have that much experience, especially in India. But I've been in the investment banking space for the last 15 years.
Hi, I'm Abhinav Dhal. I work for Standard Chartered Private Equity. Standard Chartered Private Equity is the private equity arm of the Standard Chartered Bank. We have invested about $6 billion of capital over the last several years. We are a sector agnostic fund investing across all sectors. I joined the fund in the last year. And prior to that, I worked with another fund, another mid-market fund, which is Multiples Private Equity for the last 6 years or so. Prior to that, I spent about 14 years in the US, spent a few years working at McKinsey in New York office. Back in the late 90s, early 2000s, when the first tech wave happened, I was in California working at one of these interesting tech companies. So that's a quick background.
Thanks very much. Very quick background about myself. I work in a lower mid-market private equity firm, have been investing for almost 20 years now. So I think with this, what we would do is that I'll request each one of you to comment on two aspects. One is, of course, in what I said at the beginning, how to skin the cat. Is mid-market an opportunity where one should be looking at from a pure sector perspective, or is this, or a mix of sector, promoters, everything? And second thing, which is probably of greater interest, is that going forward, 2018-19, how are you looking at the opportunities in mid-market from a sector perspective? And I'm not just asking for which specific sectors you think opportunities come up, because I think most of us know that there are going to be broadly 3 or 4 sectors. But do you see approaching deal-making in mid-market for the sectoral, I would say, a sectoral view, or is it the good old, promoter view? And maybe, I'll start again, Gopal, with you, and then we can move on. And then after that, we can do, questions as it comes.
So for growth capital in general, let's take a step back. I think the key question here is specialization. So the reason you need specialization, and we'll come to sector agnostic, sector specific a little later, is because in growth capital, unlike venture capital, which is the stage before this, portfolios are a little more concentrated, right? Why are portfolios more concentrated is because growth capital firms, spend a lot of their time on portfolio management. And when you're looking at, therefore, you by nature need to build smaller portfolios than what venture capital firms typically do. And I know, we are a very young industry, so you will see many of these trends kind of play out more and more over the last 10 years. And we should not go by what necessarily has been done in the last 15 years. So you will see growth capital firms have more and more concentrated portfolios. Axiomatically, therefore, there is a need for specialization. And I think the question you're asking is, do we go all the way to say we only invest in one sector? Or, as some of us have chosen to be, at Gaja Capital, we've chosen to be multi-sector. There is no substitute for specialization, but so far we've chosen, and take it with a pinch of salt, to be specialists in more than one sector. For us, these sectors have been education, consumer, and financial services. The last point I'll make on this is all just to do with Gaja Capital, which is, I think your choice of approach is also governed by how you invest. And there are broadly 2 ways of looking at the world, and most of us do both, which is top-down and bottom-up. At Gaja Capital, we do a lot of top-down. So it's a lot of EIBC, the classic top-down economy, industry, business, company. This drives our sector coverage. So our view of the world, to answer your question, Jayanta, and this is different strokes for different folks. But for us, our view of looking at the world is really sector first.
Thanks. Sri?
So, our origins, when we got started, we started with already a slightly differentiated strategy, and that strategy, as I mentioned, a large part of capital going into control transactions, and that was, as a market, non-existent in India for a long time. So we couldn't afford to focus on sectors, to be honest, because if you want to do a control transaction only in consumer, there weren't any. So you'd probably do the wrong deal just because you had only one sector to go after. Plus, of course, for a long time, we also believed that the sectors in India, right or wrong, difficult to say, but sectors in India are not deep enough. So we never sort of bothered to focus on sectors for a long, 15 of our 18 years, I would say we believed in ourselves that we are sector agnostic, and we've chosen to be sector agnostic. We will look at all transactions across sectors because we already are trying to address a market which is very small. But today, actually, we probably fully pivoted within the firm. If teams are aligned sectorally, if you look back, like it or not, 70% of our investments happen to be in 3 sectors over the last 18 years. Coincidentally, maybe, but now those sectors are also the sectors that we continue to believe in, and so we have now decided to focus on them. Not exclusively, again, as I said, I think we believe that about 70–80% of the money that we'll invest in will go into these 3 sectors, because those are also the sectors practically probably everybody in this forum or everybody in the market will focus on. It's not like we found anything new. But that's an evolution that we've seen within the firm.
So Inderbir, apart from the overall comment, maybe since IFC has a much larger global experience, I would like you to also comment on something which Sri said, that maybe there's not enough depth. But is that the right way of looking at it? Just because you do not have enough depth, that's why you invest across sectors? Or is it probably from an outcome perspective a better idea to say, hey, I decide that I will do only these 2 sectors, and I will kind of go through the waves? I mean, for example, 20 years back when private equity or venture capital really started in India, everything was tech, right? Most of the money went into tech. Now, tech is now a big boys game, or the emerging tech. In the middle, you don't have any not much tech investment as such. So maybe from beyond just India, given the IFC experience that you have, if you can just give us a flavor of how you would look at that.
Yeah. Okay. So I think you're absolutely right. I mean, it depends on the starting point. So we whether have the luxury or are unfortunate that we're not only an India investor, right? So I think we have the luxury that we can be very sector specialized. In fact, the whole organization is sector specialized, and investment teams, I think, spend their entire life in the organization, many of them not doing any other sector other than what they do. And that is also reinforced by the fact that we have about 85 people globally who are what we call industry specialists. So these are people who are in their 50s, 60s, who we bring from the industry, and now fashionable to call operating partners, but I think IFC has been doing it for 50, 60 years, with people on the rolls who focus on only one sector, right? So they go around doing due diligence across the world in, say, cement, or in healthcare, or financial services. So for us, we've been fortunate that we focused only on sector. And if a market has not been deep enough for one particular sector, we've either found niches in that sector which are usually ignored, or we waited for the sectors to come. So for example, we did our first microfinance deal in 2000. Or 99 actually, in India. We did our first financial services deal as a founding private equity, founding stake in HDFC, right, in 1979. So for us, we focused on sector, and we've believed that because our sector expertise is what differentiates us, we will do only a certain few sectors. Now, of course, unlike most other private equity funds, we don't have to worry about number of people because we're a global organization, and we can have 80 people looking at one sector globally, right? But obviously, if you're a private equity fund in India, you can't have, and you have 10 people, you can't expect them to wait for the sector to mature. But we believe that we continue to believe that sector is the right way to go. Luckily, we have many sectors that we are specialized in because of the global footprint. But we also have a very clear understanding of which sectors we don't have expertise in. So for example, the previous panel was on real estate. We don't have expertise in real estate. So however attractive a mid-market deal happens in real estate, we don't do it, right? But on the other hand, we look at sectors which most people don't look at. So we do a lot of manufacturing deals. We do a lot of agribusiness deals, which most funds may not have specialization in because they think consumer, healthcare, and financial services are more attractive or more bang for the buck. So we look at those sectors which many other people don't look at because we have the in-house specialization globally.
I'll come back to you on a follow-up question, but maybe after Akshay and Abhi. Akshay, you have a unique situation because you're an LP, you're a GP, you're an allocator, and not necessarily you're looking at it only from India perspective, I presume. So.
That's right. So as you mentioned, our problem is quite different. We don't necessarily have to invest in India, so we are kind of spoiled for choice in that sense. And I would tend to agree. I would kind of have the same philosophy as Inderbir here because we believe that a lot of value can be extracted by sector specialization, and a lot of these funds have, gained depth by spreading themselves across geographies rather than single country, across a region or so on and so forth. So that gives us the diversification that we require. But again, we are not investing, so we are not a single investor. So that's the other issue, and it's an issue, but it's also what we do. So because we're advising a number of different families, we have to look at their portfolios in a more holistic manner. And in certain portfolios, we find that they would benefit more from a sector specialized fund, and certain portfolios require more well-rounded, I mean, we can be quite satisfied with well-rounded private equity funds, which don't necessarily have a single sector focus.
Would you then say that there are certain sectors which need the specialization? For example, we've had a few healthcare-focused funds only. Or, maybe you don't really require, say, a consumer specialist, because consumer is a very broad range. And is that what you would say? Or you would say, because, most of the people say about India who have been investing in India that it's an opportunity, is a country for opportunistic deal making. Today, you will get opportunity in EPC. Tomorrow, you will probably get an opportunity in Autocomp. Third day, it'll be probably a mid-market IT services company, So the sector specialization is overrated. Would you say that?
Well, I think certain, as you said, certain sectors warrant a specialist team. I think healthcare and biotech, for example, is one of those sectors. I think it requires very deep understanding of the dynamics. Certain ones like consumer may or may not require, a lot of, we could, I guess a more generalist perspective could work because, they're placed on the larger consumption, per se.
Okay, thanks. Abhi?
So first of all, I wish on the panel we had representation from one sector specific fund, like someone like a Quadria or Investment or one of these healthcare funds, who are among the better performing, I think, funds in India which are sector focused. So would have been great to have somebody like that. I think all of us pretty much do come from a sector agnostic perspective. So I'll tell you, at least I agree with what everybody said on the panel regarding why sector specialization within the teams makes sense. So while we are sector agnostic, we specialize within the teams. We align ourselves by sectors within the teams, right, for the same reasons. I would just add a couple of points to to all of that, is that different sectors follow different cycles, okay, and they don't necessarily go in lockstep. So I'll give you an example. So if you look at, for example, the tech sector, in 2009 timeframe when the markets came down, which is when the multiples of tech companies came down to in the range of 8 to 10 range, which was a great time to actually enter those sectors, right? Over time, by 2012, 2013, a lot of growth happened. Sector got rated upwards. You were seeing, more than double of the multiples that you saw in that era, in the 2009 era. So that was a great run for private equity. Any private equity fund that invested in that era made tons of money on the sector. But then, then the sector headwinds came, and there's a disruption that is going on in the tech space that was started to become evident, in the growth rates and EBITDA margins of all these players, and from that point on, the sector derated. Now, if you compare that to hospital space, it rated and derated at a different point in time. Hospital space, at that time in 2009, Apollo was probably the only listed player. When I say hospital, was the only listed player in the market. Over time, over the next 5 or 6 years, newer players came to the market. New IPO stories came to the market. Dr. Lal, came to the market. Newer hospitals like HCG, Narayana came to the market, and therefore the whole sector got rated upwards, right? And then, this happened over until 2016. So different time frame from the tech sector, right? A very different time frame. In the last year, 2017, the hospital sector has come under a lot of regulatory scrutiny and pressure. Price controls on stents, government sort of actions that have warranted derating the multiples. What the margins the industry will have going forward is getting a little unclear at the moment, right? And therefore, the point I'm making is different sectors don't work in lockstep, and therefore having a single sector fund in a country like India can actually be quite dangerous. And then, from the exit standpoint, the same thing holds from the exit standpoint as well. Because the cycles happen at different times, you want to exit out of your investments at different times as well across different sectors. And, that is, for example, we recently exited one of our investments called Sterlite Power Grid Ventures, which was an infra bet. We took the bet in 2014, around about that time frame, when infra was actually out of favor. It was a very contrarian bet to back a player in the transmission space. So it was, it was not a sector in favor, completely out of favor. Nobody was investing infra prior to the Modi era. And after that, we recently exited, made a very handsome, 2x dollar return on the investment. And, partly because infra is, getting a positive sort of kick up and a wave at this point. So, along with that, you ride that. You can get too greedy and keep riding till the very top, but, you've got to kind of hedge your bets at times. So that's what I would say regarding why sector-specific funds versus agnostic funds?
So, so far we've been talking a lot about from an investing perspective, is it better to be investing if you are easier to invest if you're sector specific? But I want to just look at it from the recipient's perspective. Mid-market companies are typically, in the Indian case, promoter-led. There'll be really very thin management. And it's not necessarily that that promoter is doing this business for the third time in life. He's probably doing it for the first time. And maybe, one is in, say, in a personal care. But does sector specialists within the firms, and Gopal, maybe you can talk about it because you've invested a lot in, say, in education, in financial services, and consumer areas, that from a value addition standpoint, how does a promoter view firms? And it's not that there's a huge amount of sector specialist funds available in the mid-market, but would a promoter who's taking money, growth capital, differentiate between firm A and firm B depending on what's the quality or depth of specialists in the firm? Or is it the other way around? Is it that the promoter says, no, all that I really want is your money and your governance and your aura and all that stuff. I really don't want you to tell me how to sell, say, personal care or how to run a restaurant chain. And how does it work? And you've got such a huge depth of experience. Maybe you can share some specific situations without necessarily taking names, though.
I'm yet to meet an entrepreneur who isn't focused on valuation, right? After all these years. But private equity investors love to talk about value add and how life is only about value add and not about valuation.
Absolutely.
Right? I think, first of all, I think, I wear two hats. I'm an entrepreneur and an investor. And as an entrepreneur, I know that every growth company needs help. It needs more than capital. And that also sits very well with my experience, that the reality is that companies in today's world, this is 26 years after 1991, this is no longer a scarcity-led economy. This is an increasingly competitive economy. You need value add. Secondly, I would say that the amount of value that investors can add is a little more than what companies feel they can, and a little less than what investors think they can, right? So it's somewhere in the middle. Third, I think the way we've gone about it, about this is that, is to focus on the walk as well as the talk. And, of course, first you start with the talk. But the way we've kind of walked this talk is by staffing ourselves appropriately. In order to deliver value add, you have to build teams accordingly. You have to have people in the team, capable, well-paid people in the team, senior people in the team, who are not focused on doing deals. And who come to the office every day thinking about portfolio companies and what these companies need. I think as we've built this operating team within Gaja Capital, our ability to add value has increased and improved. Yes, I do think entrepreneurs think about the firm's ability to add value. I do think entrepreneurs, given all other things being equal, would choose a firm that can add more value and has a better track record. But the first thing they do look at is valuation. It's valuation, valuation, valuation. All things being equal, it's the ability to add value and track record.
Yeah, just to follow up on that, Gopal, situations, evaluation, of course, all of us agree. Now, what in your experience, an entrepreneur, how does an entrepreneur react when he finds, for example, let's say suppose we are investing in a new pizza chain, which none of us have had in the recent times, so it's a theoretical example. And then you have in your team a former CEO of a pizza chain. And this entrepreneur is very passionate, etc. He's built a great, 50 outlet chain, but now wants to go to the 500 outlet. And then you put on the board your pizza specialist. What in your experience has been the reaction of the entrepreneur? Does he or she welcome that, or he looks upon this as an interference that, this gentleman probably is 52 and he has seen it in his time, I'm 36 and world has changed. Typically that's what we hear, that from your perspective, but reality is different today. Is that what you hear, or you see a lot of welcoming of this experienced person?
Well, I see both. I think it depends on the personality of the entrepreneur. Really, there is no other way to describe this. There is no one answer that fits all. There are entrepreneurs that are welcoming. There are entrepreneurs that give us greater engagement because we have sector expertise. or we have people within our team that can help them build businesses. And there are entrepreneurs that are alarmed because of their own experiences that, will Gaja Capital be an interfering investor? For us, it's very clear. What's changed? Let's just take a step back. What has changed for us over the last 10 years? 10 years ago, 0% of our business was control. Today, 1/3 of our business is control. 10 years from now, 2/3 of our business will be control. Let's go back 10 years. 10 years ago, 100% of our business was low touch. Today, 2/3 of our business is high touch. For us, it's very clear that we are going to be a high touch growth capital investor. And therefore, we will end up, there'll be self-selection. We'll end up working with entrepreneurs who like our high touch approach. Some of them will sell us control. Some of them will sell us significant minority. And some of them will sell us only minority. But this is the way we are choosing to build our firm.
Great. Sri, from what I understand, and correct me if I'm wrong, True North or India Value Fund or GW Capital started being an only control or control-only investor. And over a period of time, you probably have introduced a little bit of non-control situations as well. So from a mid-market perspective, and obviously you're a very large firm, but mid-market companies, what are the challenges of deal-making in control situations in mid-market? Not necessarily where you've just done ground up, but where you've taken a control of an existing company. What are the challenges? Or is that the mid-market control opportunity very different from, say, a large control deal where you're talking about companies in excess of, say, $200 million or $300 million existing revenues? Is there a practical, a real difference between the two?
Yeah, I think, it is different for obvious reasons, because the maturity level of the company is much different, I suppose. But what we are observing over the years is also quite interesting. One, when we started doing whatever we are doing, which is investing in businesses, getting involved in the operations of the business, etc., we didn't have a very deep private equity industry as well. Most of the times, we are providing growth capital and in the process probably taking control of those businesses. And we were most certainly the first time investor in those companies. But today, if you look at the kind of transactions that we're doing, there are mid-market companies, but many of the companies that we are investing now are no longer first time to private equity. There are already 1 or 2 investors there. And the kind of transaction that we are doing has also evolved. So it might be growth capital plus secondary for 1 or 2 investors. And in the process, maybe ending up in control. So the kind of value add that we were doing maybe 10 years ago or 15 years ago is very different from what we are doing now. Because putting in place the governance structure, putting in place basic MIS or good quality finance function, those are the things that we used to do, bring in right auditors, etc. Those are the things that we used to do maybe 15 years ago. Today, we don't need to do them because they're all, I think, well-governed, reasonably well-governed. So that is also the reason why we believe actually that sector specialization is even more important, because if you need to make tangible value add to these companies, then it's not like you're going to bring EY as an auditor and then life will suddenly improve. Right?
No, are you saying that even in a minority situation of a reasonably later stage mid-market company, you are being able to come in and really guide the company where you're a minority, not a control situation?
Yeah.
As a minority investor, make a serious difference in the way business is done beyond the structural aspects of governance and MIS and all of that stuff?
Yes, I think there are 2 things that today I think we are able to do. One, firstly, I think in a minority situation, we need to be very clear that the person who's driving the business is the entrepreneur. We are not trying to we shouldn't try to drive the business, and neither are we trying to. We should be very clear that we are comfortable in letting the entrepreneur drive the business and taking all the important decisions. We can only support him, right? So otherwise, it's not going to work. Now, support is context specific. Sometimes it is, let's say, for example, we invest in a NBFC, let's say, a financial services business. Most important thing for them is really cost of funds. Can we bring our own, so the one interesting thing, I'm sorry, it's a little off, but the biggest challenge that we faced in the companies that we took control in 10 years ago is really to get debt funding to those companies because we were the promoters. We would not give promoter guarantees. There was no funding available, debt funding available. But over the years, we changed that. So we have now a lot of banks who believe that under our ownership, companies can prosper and banks can get paid back without a guarantee being given by us. Now, so maybe we can bring 1 or 2 relationships of those banks to lend to them at a cost of funds which is significantly lower than what they were otherwise having. Maybe we can bring, let's say, a housing finance company wanting to start a lab business. We can bring a head of lab business because we have some roster of people who we have been in touch with. Those are the kind of value add that we'll probably do, not changing auditors, not putting MIS systems in place.
So I'll just belabor a little bit on that. See, again, the example which you gave was helping them get finances. I think always, at least in my experience I have seen, if you are helping raise capital, whether you're 2% shareholder or 98% shareholder, you're most welcome. Yeah. But try and advise an entrepreneur who's trying to build his brand, saying that you think in, in a particular trajectory, and I as a shareholder, with assuming, and not me personally, but say, suppose I've got a brand specialist, I think you should build a brand differently. What happens in those situations, particularly where you have minority? That's again anecdotal.
Yeah,
you can share something.
No, I think one is again I think go back to rule number 1. If there is a difference, we are in minority. We know who's driving the business. Then we should respect that rule number 1.
Even when you are very convinced that that's not the right thing to do, because you're not just a financial investor sitting. Yeah. You are somebody who's sitting with a lot of experience in that particular domain, for example.
Absolutely. So go back to rule number 1, I think. But I think, see, it's about your ability to intellectually convince him. If you can't, go back to rule number 1. Otherwise, you're creating more problems for yourself.
Okay, that's fairly candid. In the is there a difference in the way Indian entrepreneurs, in your experience, I would say, react to a PE fund, PE investor value add compared to, say, the rest of Southeast Asia or other geographies where you operate in, or is it all pretty much the same story?
Yeah, I think it's quite. I mean, it's both same and different. So I think it's also evolution of market. So when we used to do, so for example, when we did deals in 2005 to 2010, right? And it was, at that time, people may be surprised to hear, but NBFCs was not fashionable, but we did many. We did like 8 NBFCs, including microfinance, housing finance, and all of that. The entrepreneurs, so for me, one of the tests has always been, while I agree that valuation, I can cite at least 4 or 5 deals of those that we did where the entrepreneur chose IFC, not necessarily because they thought we'll have more value add, but because of our sector specialization, they thought we understood them better. So maybe we'll be able to understand when they go through tough times. It was an hypothesis in their part. And therefore, for me, that is, especially if you're doing minority, to coming back to his rule number 1, if you're doing minority, right, I think most of your tale is already written before you enter. And if before you enter, the only thing that you can really test is whether the entrepreneur really wants you or wants your money, right? And there are only a few non-verbal cues that you can get to find out whether that relationship eventually is going to be like you hope it is, right? So to come back to your point, entrepreneurs today in India, right, mid-market entrepreneurs, and of course the definition of mid-market has changed, are all relatively more sophisticated. Like you were saying, some of the stuff that you could, simple corporate governance stuff that you could do is no longer needed. Also because A, they think they know it, and B, I have yet to come across any deal which is not intermediated by bankers, right? And there are boutique bankers, some of them are here as well, so they know how to sell the story. So really, I find a big difference now than 10 years ago. But I find in many Southeast Asian markets the same situation, right? Where if you go to Vietnam, most entrepreneurs will tell you they want you for your value add, but actually they don't necessarily want you for your value add. But in certain situations, the same entrepreneur is really, willing to take you. So I'm unfortunately not able to tell you whether entrepreneurs are different or not, but I can tell you definitely that in India now, entrepreneurs are far more sophisticated. They know exactly what they want. And for us also, it's better if we find out up front that they really don't want our advice as a specialist, but they want our name and a few things on the corporate governance, so at least you know what you're going into. You may choose not to do that deal, but I think now it's easier to find out what the entrepreneur wants than what it was 10 years ago.
Please go ahead.
I want to just kind of unpeel that word sophistication. To me, I think it boils down to experience. So just to take that question, I think, in the US, let's take the venture capital private equity market. It's a 40-year-old market, right? In India, it's barely a 20-year-old market. And we've only recently adopted capitalism, and that too half-heartedly. I think there's a marked difference in attitude between experienced entrepreneurs and first-time entrepreneurs. Experienced entrepreneurs are more amenable to having a conversation, the kind that you're talking about, which is a richer texture and which is about appreciating value add. They're more secure, and they've seen the tape before, so they know it's not just about capital. Right? And if I was to see a pattern in my experiences, I think that's the pattern I see, which is if you're dealing with experienced entrepreneurs, then you have an easier conversation, you have more appreciation of value add, sector expertise, etc.
That's, Abhi, just want to skip to you. You've kind of worked in the tech sector as well at some point in time in the past. And when we talk about mid-market, like we agreed, more or less mid-market in India connotes opportunities in consumer, healthcare, financial services, broadly speaking. Tech, as we understood, say, 10, 15 years ago, which was plain IT services, which are primarily body shopping, slowly morphed into a few product companies looking at domestic markets or etc. But the action in tech was either in venture capital, really early stage high-tech companies, or later stage where you have very large tech services companies. But do you see from a mid-market perspective, tech opportunities in mid-market coming up? And this is a question to all of you here, because in mid-market, we normally tend to avoid getting much into tech. So we start with you, and then, please feel free to, jump in.
Yeah, so I think, we have, as a country, seen the emergence of internet and internet-enabled models over the last few years, right? Venture capital funded some of the companies early on. Classic venture players like Nexus, Matrix Partners, Lightspeed, all these players funded the initial round of companies. And then slowly the capital need for these companies increased, but at that time, there were hardly any mid-market funds available to actually fund, this first round of players, these players who needed a next round of capital at this point. The need that over, in 2014 to 16 timeframe got filled in by the hedge funds and the likes of, funds like SoftBank, Tiger Global, SteadView, and so on, right? All these funds came in, saw the opportunity that there's nobody else available. They had tasted success in the Chinese market before, and they kind of lapped onto that opportunity. So I think the Indian mid-market funds were late to jump onto that. I personally had, having worked at Multiples, which was the previous fund that I worked with, we took a very conscious bet on, we looked at the e-commerce space very, very closely and, decided that that's not the space we wanted to be in. Instead, the conclusion, looking at the sector in a lot of depth was that the derivatives of e-commerce were a lot more interesting. And, the two derivatives that we finalized, came upon were basically logistics and payments. And then, we kind of did a deep dive into each one of them. But out of the logistics, sort of getting deep into that segment, we identified the opportunity to kind of invest in delivery. And, I think those are the kind of models which are, and the challenge, in investing in these models for mid-market funds is these are EBITDA negative companies, right? These are not the companies generally most of the mid-market funds are used to investing in because they can technically mean a capital loss. Right? And a lot of funds don't want to even entertain the notion of a capital loss, and therefore, it kind of, falls through the cracks in most places. So I think all mid-market funds today have a great opportunity in front of them to figure out a strategy to attack this particular, segment out there. And I think just from experience, I'll say, at least the way we tackled it was thinking like a growth investor or thinking like a, a late stage fund, but doing an early stage investment. So for what I mean by that is putting a lot of rigor into things like unit economics and really sort of ensuring that unit economics was indeed panning out. So I'll give you, just to kind of draw out the insight. If you look at a player like Delhivery, which is a very large net. This is a company that is the FedEx of Indian e-commerce. That's basically what this company is, right? It picks up the packages from Flipkart, Amazon, and so on, and delivers to your doorstep, right? Through a network of several intermediate locations across the country. Now, when I say we put a lot of rigor into unit economics, what I mean is, the way the evaluation sort of happened for us is that we sort of said, okay, fine, let's divide this company into two parts, right? One part is a very mature network, which is a classic way to think about same-store sales growth in a retail fashion, right? Where the stores have matured and they have economics that's evident, right? And we noticed that economics was working out well for that piece of the network. The network was growing very, very rapidly, and therefore, when you look at on a combined basis, the unit economics doesn't seem to pan out. But when you look deeper, and you kind of keep dissecting, and it's nth level of dissection that you do to come up with these kind of answers, you're able to arrive at the right answer for these things. So I think bringing the later stage type of mindset into select situations is where sort of we picked up our battles, and we were able to have a lot of success come out of that investment. And I think for the fund, this so far has been a multi-bagger bet that the fund ultimately so that changed the DNA of the fund as well over time, because we approached the problem saying, how can we do this? And then coming out of it, we got a lot more comfortable. And as you get more comfortable with taking those bets, you're able to sort of expand your horizon and do more. So I think that's a great opportunity for all mid-market funds to think about and expand into. At Standard Chartered, we have taken such bets, not in India, but in China. For example, ZTO Express, which is one of the largest e-commerce logistics companies, is in our portfolio. And then Souk.com was another bet that we took. So we came from a very classic growth and late stage investing mindset, and we morphed ourselves slowly into investing into these type of opportunities. And that's the next round of opportunity we are looking at in India as well.
Great. So we are almost out of time. So what I would request, maybe starting with Akshay, kind of an overall commentary as to what do you think are the 2 or 3 key things one must look out in mid-market investing in India, and then maybe Inder B, Sri, Gopal can follow it up.
Well, I don't really have any specific India-specific pointers, but one thing we look for in any private equity fund is a very robust risk management framework. Basically, how are they going to address many of the problems that my panelists here have outlined, especially around exits, especially around how to manage entrepreneurs, because a lot of times things can go sour between entrepreneurs and private equity firms because there's a lot of friction and differences in vision. I mean, obviously, when it's time to take the check, all visions are aligned. But once the check has been cashed, things can go in very different directions. So it's important to see what kind of controls they put in place, what kind of rights they negotiate, what kind of management they can actually put in place to influence the direction of the company. I think all of these things are extremely important and not really something to be taken lightly.
Thanks. Inder B.
I think you already summarized promoter, but I think that's a necessary condition without which we don't do any deals. But also the sector, I think, coming back to the topic of this discussion, and I don't mean sectors which you think are fashionable, but if you have the sector's expertise, if you're going especially mid-market, and first time you're planning to do minority, and you don't have the sector expertise, I think that's a recipe for disaster, even however tempting the opportunity may be. And that's tough, given that India, you asked the question of how deep it is. India may not be very deep by every sector, but it's very deep in terms of the number of opportunities that you can see in the mid-market space. So I think that would be, I think, what I would look at.
So if you're new kid off the block in India, if you don't know the market, at least you better know your industry.
Absolutely. I mean, I assume you'll anyway look at promoter, but yeah, you have to know your industry. Yeah.
Thanks. Great. Sri?
So I'm not saying anything new. So I think the market is really large. There is no doubt about it. The opportunity for a lot of people. But so is the competition, the number of really mature players now, I think. I mean, the big difference is really that most of the players who are there are really mature players, good quality players. Very little to choose from externally. So we actually genuinely believe that the only way to win is to specialize in sectors. And sectors are also a misused word, right? You're really about small subsegments that where you find your niches and some specialization that you can bank on to really make tangible value add in those companies post-investment. So we have actually completely pivoted organizationally. Hopefully it will help us.
Great, thank you. Gopal, something I would like you to comment, and the last word, so to speak, in today's discussion, is that what would your word of advice be for folks who are trying to come into Indian mid-market? Obviously you've had great experience, many successes, mega successes. In the back of that, and given the way things are changing, what will be 1 or 2 words of advice for new folks who are coming in trying to do Indian mid-market PE?
We as an industry have also matured. So this is no longer a sunrise sector. And therefore, I think the rules of, the rules around how firms are born has changed. I think increasingly for a new GP to be born, there has to be a track record. And, you can't raise your capital after announcing a firm. You have to have the capital. Third, I would say is, of course, specialization. We love to talk about differentiation. We know that's difficult to implement, easy to say. But what has changed over the last 10 years? 10 years ago, GPs were being born simply because there weren't enough GPs. But today, capital, the bar has gone up. It's difficult for GPs to come into being. There are very few white spaces. You need to have a track record. I need to have capital there. I was thinking, so maybe we should end there.
Okay,
and it's got 0-0 on the dial.
Yeah, maybe we'll skip on the audience question and.
Should I?
Yeah, but please complete your point.
No, I was just thinking about, what is it that makes a great growth investment? I don't think I have anything to add. But I was reminded that, all of us should and do spend a lot of our time thinking about, things that other people aren't necessarily thinking about. And I think at the heart of investing is being a little ahead of the curve. Now the industry, the private equity industry is full of brilliant, extremely intelligent, capable, agile people. So it's easier said than done, right? You're really up against grandmasters. So, so it's difficult to say that you can spot things, and it's getting tougher and tougher to spot things that others don't think. But, for me, the aha moment is being in a situation where I suddenly realize that there is nobody else looking at it. Yes, things can still get spoiled if there is still an investment banker. But having said that, I think those are my aha moments. And it doesn't come very frequently. I think it comes less frequently than it used to a few years ago because the industry has become far more competitive.
Great. Thank you so much. We obviously, as you know, we are running a deficit on time. So I don't think we'll have an opportunity to do our audience questions, but I think all of us are going to be around in case any of you wish to follow up. We'll be very happy to do that. Thank you very much. It was a pleasure moderating this panel. And have a good evening, and have a good evening to all of you.